Hello, Ira Coiner here, President and founder of Triathlon Partners. Thank you very much for tuning into this episode of Triathlon TV. We will be discussing charitable giving once again. Thanks for the overwhelming positive response and the reach outs on the last episode. We hope it definitely seems like it served as a very good and solid foundation for charitable giving for everyone out there. I wanted to expand on that topic because there's another very clever way that you can manage your giving that doesn't affect the charity, but it actually you have an opportunity to maximize your tax deductions, which really means you can give more, which is great, right? So what I'm talking about is a donor advised fund. It sounds very complicated. It's very easy. All right, you come to Triathlon Partners. It's like setting up a brokerage account. That's it. You fill out some paperwork, 90 seconds on a DocuSign, it's done. Okay, so what you do and why we do this is when you normally give to charity. Now, we know everyone now is going to give appreciated securities because they're going to get a bigger bang for their buck for their charity. So instead of giving to the charity every year, because you're working on the basis of the charity needs money every year to fund itself and to do all the great things they do, we're going to look at your finances, right? And we're going to decide, well, we get this charitable deduction when we give to charity. And our charitable deductions are worth more when we earn more money and we're in a higher tax bracket than when we're in a lower tax bracket. But we don't want our charities to be at the negative side of what our tax bracket is or how we're earning money, et cetera, et cetera. So because when you're earning less money, you might be less tempted to give money to charity because you don't have as much, even though I know you want to give. So what we do is if you're an individual who expects to have some fluctuation in your earnings, or maybe someone who's approaching retiring, and they're going to have a big drop off in that earned income space, right? This is something you got to listen to, right? So right now, the difference between money earning when you earn income at $200,000, when you earn it below $200,000, you pay 24% on every dollar effectively in taxes. When you earn over $200,000, you pay 32% of every dollar. That's a big difference. That's 8 cents difference, right? So, and that's for an individual. Married couple, numbers twice as much. That's how the tax brackets work. So that number is $400,000. All right. So we're talking about high-performing individuals who have salaries and income streams coming in. But, this is something everyone just has to keep in mind, right? Because that's, if you're able to give more when you're earning more money, basically you're saving 8 cents on every dollar. That's a lot. Your charity can get 8% more. So what you do is instead of giving to the charity every year, because that's when they need it, if you have these expected fluctuations in your income coming up that and you're above that, you're into that higher tax bracket, you give more money that year, but you don't give it to the charity. You give that money to what's called a donor advised fund. Now, it's just another brokerage account that you can have Fidelity or Schwab. It holds stuff from the market. You move your appreciated assets in there. We talked about it. You get that this sort of discount because you don't have to pay taxes on your capital gains. And you get a deduction on all the money you've put in that year. So you're in the higher tax bracket. You put in a large sum. You get that extra 8 cents off. As opposed to 24%, you get it 32%. And then you decide when you want to disperse the money to the charity. So if your habit was to give the same amount every year, well, you could put a big sum in the donor advised fund and you distribute it to the charity when you want. And that you just have to manage your own giving, but you might actually be able to get more money out of it because you're getting a bigger tax savings. So somebody who's in their 60s and a single person, and they've done very well and they're earning over $200,000, and they want to give to charity while they're retiring, but when they retire, their income is going to go down to 150. Well, giving when you're earning 150, you're only getting 24 cents on the dollar as a tax rebate, as opposed to above you're going to get a 32 cents rebate, right? And you're going to get that rebate immediately when you give. So it's always better to get those bigger refund checks now than later, and to get bigger ones. And you're able to control, and your charity's still getting the money. These donor advisor funds, it's not some big wig, it's not someone who's going to lose your money. You have the investments in basically the same thing that you currently have them in. It's just in a separate account, right? It's sort of like, you give some money to your kid, you have a separate account you save for vacation. There's a separate account you save for charity, and you get the big deduction on your timeline. If this scenario fits you, it's great. And I hope for those people that it does fit, they're able to take advantage of it, because it means their causes and their donations will go further. So thank you again for tuning in. I hope this was very educational. That's part of our firm. We want to educate, we want to engage, we want to empower our clients so they can make a confident decision that best meets their objectives. And once again, we like our stuff at Triathlon Partners. So please, subscribers, thumbs up, friends and followers, click those buttons on social media. They really help us out, and they keep the good advice and the money saving, money maximizing tips coming your way. Check us out, www.triathlonpartners.com. And I will be sharing the disclaimers now, because they're very important to watch the disclaimers. Someone's got to call me and show me how to do this a little bit quicker, yeah? There we go. All right, everyone have a wonderful and blessed day. We'll catch you at the next episode. Take care. Bye.